we'll be back in September. Seems like you all know who Sandy is. He's on the radio on Saturday morning investment show. He's the principal at the Sanford Family Financial Partners. I'm just saying to him, looks like a lot of his clients are here. So he's going to tell us today about a book called Wall Street versus America, The Rampant Greed and Dishonesty That Imperil Your Investments by Gary Weiss. And so here's Sandy to tell us all about it.
Thank you, Joe, and thanks for the opportunity to review this book. It's called Wall Street versus America. It's an interesting book. I took it with a little bit of a tongue-in-cheek. The author is a former business writer for Business Week, and he's written one other book, and just the name of his previous book leads me to be somewhat subject to concern about what he's writing in this book. And his previous book is Wall Street and the Mob. So he talks about, in his previous book, how the mob influences Wall Street. And this book deals with a lot of greed and dishonesty, according to his point of view, what happens with your investments, and as you and me, the individual investor, is really taken as victims, according to Gary Weiss. And the regulators, the arbitrators, the media all look the other way, according to Gary Weiss. And his theme throughout this book is that the market is ruled by two things: greed and emotion. And it certainly is. There's a lot of greed to do with your stock market investments, whether they're individual stocks or mutual funds. There's certainly a lot of greed on Wall Street. Going back to the old movie with Michael Douglas, remember that? Wall Street, and how Gordon Gekko and greed, and how greed is good. Well, he takes that to a written format in his book about greed, and it's a book about his opinions about how Wall Street really rips us off, the individual investor, including me, who makes a living out of this business. And it's the very fabric of Wall Street and its practices, according to Weiss, that encourages corruption. And it really asks us as individual investors to somewhat make sense of what happens on Wall Street, and to take it into heart when you go to sign up with a broker. And I'll go through some of his themes. The book is a number of mini stories, and he talks a lot about, well, let's go right up to the start of it. He talks about the New York Stock Exchange, the pillars of Wall Street. You know, you go down to Wall Street in Manhattan, and you see now that it's really become somewhat of a residential neighborhood as well. As you read in the papers, a lot of people are going into that area to take their living, to live there. And you'll see on one corner, you'll see a BMW dealership, and the other corner, you'll see a lot of high-end retail stores. So Wall Street has become more than just a daily place to go to work. And he gets right onto the New York Stock Exchange as the self-regulatory body that really takes us under its umbrella and directs how we make our living. And he says that the New York Stock Exchange, even though it's a regulatory body, is a self-regulatory body, and that they control what happens, and they really fail to enforce and supervise the industry, according to Gary Weiss. Well, and he calls it a good old boys network, and how they really, you know, they give the opinion that they're regulating the industry, but they're really not. They're turning the other cheek, according to Gary Weiss. Let me just give you some opinions of that from my standpoint. I've been in the business for 30 years now. It is a good old boys network, and it's much cleaner now than it has been. Back 10 years ago, there was no supervision, so to speak, of my industry. From my standpoint, I could receive gifts from companies that had endless value, and I could conduct activities that were held outside of this industry. Now, it's much different from my standpoint. I can't, I can have outside activity, but I have to depict what my outside activities are. I have to file statements every year. I cannot accept a gift from any company that's more than $25 in value. Where 10 years ago, I was going on trips all over the world, sponsored by mutual fund companies, And, you know, I take it with a grain of salt, but it did give that you know, feeling that I was influenced by companies that would send me to California every other week if I wanted to go. Now, if I'm going to a meeting, and I was at a meeting about 3 weeks ago in Boston, sponsored by a mutual fund company. It was Putnam. It was their annual meeting where we met with economists. No side trips. If I wanted to invite my wife to dinner, it was a one-night trip. If I wanted to invite my wife to dinner that night at the hotel, I had to pay for one dinner out of my pocket $195 for her attendance at dinner. Needless to say, we didn't go to dinner there because I'm not paying $195 to eat. And so it's become almost to the extreme now of regulatory nature of us in the industry. I can't accept a gift more than $25. And there are reports that have to be filed very regularly for me. So I think his comments that there's non-regulation on Wall Street do not hold up. There is regulation on Wall Street of me, and I find it very difficult to assess the accuracy of some of his comments. He's very colorful in his characterization of the SEC and its former chairman, Arthur Levitt, the former head of the stock exchange, Richard Grasso, who, by the way, got paid a ton of money. I think if you recall, he got paid, I think, $190 million as a buyout. That's a lot of money. And so his aspects of this on one chapter is too extreme, and I think old school now. The new school is very regulatory for us in the business. He talks about research and how certain companies pay for research and some companies do not pay for research. And there is a difference, according to him, and I agree with him on this point. A company that's publicly traded buys research, and they pay for that research for someone to analyze their stock and give an opinion on Wall Street. And other companies don't pay for research, and brokerage firms, Wachovia Securities, who I clear my business through, does not pay for research. They do it all in-house. They don't buy research and they don't sell research. But some companies out there, particularly individual stocks that want to increase the public's perception of them, will go out and pay for research of a company, and that's somewhat tainted in his opinion and in my opinion. He goes into commentary about boiler rooms, the penny stock scams of the past. And that's old news, but it makes for interesting reading anyway, where a penny stock company will have an active boiler room where you'll get phone calls. I get phone calls at night. I'm sure you all somewhat get some phone calls, typically around dinner time. In the past, there were companies that were not headquartered in the U.S., and they'd try to encourage you as an investor to buy a stock, a penny stock in particular. Well, guess what? While they're encouraging you to buy that stock, they're selling it. So they want you to bid up the price so that they can unload the shares themselves. And that was a scam that took place many years ago. It still is taking place a little bit today. Not so much, but it still is. And it's the boiler room approach. So the old adage is, if you don't know who you're talking to on the phone, don't take their advice. And it really holds true whether it's stock market or any other industry. I got a phone call just last night from someone asking, may I speak with the owner of the house? And I answered the phone and I said, well, he's not home right now, thanks for calling and take care. And I hung up on him. In some cases, I've done some seminars in the past on identity theft and identity fraud, and we'll be doing another one sometime this September. Don't give out your name, social security number, God, or any information about you to anyone you don't know, because they'll sell that or they'll use it against you. And so the phone call I got last night, and I'm getting it from Time Warner Cable, from telephone companies. I don't speak to anyone on the phone that I don't know. I'll ask them for their phone number and their name, and I'll call them back, and they'll hang up on me. So the boiler room approach is you know, it's good information in the book, but it's nothing that's really new. He really goes after the mutual fund industry, and I want to talk to you about the mutual fund industry for a minute now. And he says that they charge exorbitant fees and they have hidden fees. Well, any advisor worth their salt should disclose to their clients all fees that are involved with mutual funds, because there are hidden fees. There's no doubt about it. If a fund says they're a no-load fund, they don't charge you a commission up front. There are some internal expenses that are charged to you within a mutual fund. They're disclosed in the prospectus, but I don't read a prospectus, and I know there's one person in this room that reads a prospectus, but I really don't take the time to read it. And he talks about kickbacks to brokers. Well, I mentioned that briefly, that you know, if I did a large transaction with a mutual fund in the past, large transaction, my definition is $100,000 or more for an individual trade. The next day, not only would I get a phone call from the mutual fund company, but I'd get 3 or 4 dozen golf balls, I'd get golf shirts, you know, these soft dollars. And it was rampant in our business. But you know what? It's rampant in other businesses as well. And he doesn't mention that. Of course, he's talking about Wall Street versus America here. But your doctor gets paid for prescribing a certain drug, for sure. And they get invited on all these junkets around the world. And that still continues to this day, where in my business, there are no more junkets. So he's saying that mutual funds charge exorbitant fees, and that they pay for shelf space. Well, they did pay for shelf space, and that's a recent occurrence now in our business that has stopped, and that brokerage firms like myself and Merrill Lynch or Smith Barney or whomever you deal with in the past have had their A-list, B-list, and C-list of mutual funds that they would have their brokers look at. And they, in the past, have said, well, this is for accessibility, to go online and see the performance of certain mutual fund families. Well, guess what? It wasn't for your benefit. It wasn't for the broker's benefit to be able to access it. It was for the brokerage firm's benefit, because they were getting paid from the American Fund Group, from Fidelity, from Vanguard, from Dreyfus, from Putnam, from Oppenheimer, to be on this list. They would say to these firms, we'll put you on the A list, but in exchange for that, you have to give us money. And that was rampant, because I experienced it myself. My brokerage firm had, you know, the A's and the B's and the C's of preferred lists. Well, we do our own research and we kick our own tires before we make a recommendation, but a lot of brokers out there will say, well, if my firm thinks that this mutual fund should be on the A list, then it really must be. But that's not the truth. It's because they were paid from the mutual fund company to have this. And this was a scandal. It certainly has been brought to the public's attention, and I think it's gone away now, but he talks about it in the book, and he's right in that regard, that they paid for shelf space. But you know what? You go into Price Chopper today. I mentioned this on the radio show a few times. You go into Price Chopper today, and you see who's on the end kiosks. You see the big displays of Frito-Lay corn chips or Coca-Cola. Well, Price Chopper isn't doing that for their own benefit. They're getting paid from Coca-Cola and Pepsi and Frito-Lay to have that space. And this continues today. If you go down the aisle in the beverage section of Price Chopper or Hannaford or whoever, and you see a big display of Pepsi and you see a small display of Coca-Cola products, it's not because Pepsi sells much better or is a better product than Coca-Cola. It's because Pepsi has paid this organization to have that space. So it happens in the mutual fund business. Hopefully it's gone away. He talks about late day trading and how mutual fund companies would conduct trades after the close. You can only do business between 9:30 and 4 p.m., but a lot of mutual fund companies have been called on the carpet and have been fined big money, millions and millions of dollars, for for doing trades post 4 p.m. to try and work on the overseas market in particular. He talks about that in the book, and a lot of mutual funds were called on the carpet for that and for excessive trading. Typically, when you're in the mutual fund world, you're in it for the long term. You don't want the manager buying and selling excessively. That's called turnover in our world, and that incurs a lot of extra fees, which take away from the performance of a mutual fund. That's happened in the past, probably still is happening today. He talks about it. Hopefully, it's not happening as much. But Weiss is right on with that chapter on that. He's not right on as far as exorbitant fees and hidden fees. I don't think they're exorbitant. They could be hidden, but he's saying buyer beware, and I agree. Buyer be wary of anything, and ask the questions. One area that Weiss really hits on is hedge funds, and you read about hedge funds now, and hedge funds are typically unregulated mutual funds, and they were sponsored by these companies to go after the accredited investor, and that's an investor that has a lot of money and is looking for a big gain. In my opinion, we don't do hedge funds. I don't think they're safe. I don't think they're hedging the market as the word hedge depicts. They're certainly not liquid, and there are high fees involved with that. The hedge fund company takes 20% of the profits before they even cut up the rest of it to you as the investor. So they're slicing off 20% from the top on every hedge fund. And so Weiss, he rips into Attorney General Spitzer for not taking on the hedge fund industry. And he says the reason he's doing that is because I guess it costs a lot of money to run a campaign, and I guess he looks for money. And the biggest fund source for his campaign is the hedge fund industry. It is Wall Street. Now he comes on this holier than thou attitude, Spitzer does, by saying, I'm going after mutual funds, I'm going after everyone to help you as the investor. His campaign is funded huge amounts of money by the hedge fund industry. So Weiss is of the opinion that Spitzer focuses on what's a quote in his book, low-hanging fruit, the fruit that's hanging low off the tree, and that Spitzer is a hit-and-run artist. A hit-and-run artist is someone that gets the headlines, gets the positive area of that, and goes on to something else that will give him the headline. I'm in agreement with him. I think hedge funds are typically ripping off the individual investor with these hidden and excessive fees, and Spitzer hasn't done his job to go after that industry, and it's too bad. But I don't know of a lot of people, in my world anyway, that invest with hedge funds. And we're conservative to begin with, but I wouldn't say that it's rampant up here in the Capital District, more so in the big cities and with big money for sure. But the individual investor is investing in something that is not regulated at all as we speak today. So that's a tough issue. One area that I take a little bit of offense at on Mr. Weiss's comments about client agreements. He sees an evil, and he calls it an evil, in the agreements that you sign when you go to sign up for a brokerage account with a financial advisor. And that the agreements that you sign, if you've read them, are one-sided, according to Weiss, in that it strips you of your rights if there's a dispute. I don't know if you've seen this or not, but it is in there. And it says that you as the investor have access not through the courts, but through the arbitration process should you have an issue with your stockbroker, your financial advisor, or the firm that they're representing. And it's documented it's built into the new account form that you sign. In the past, you've seen, I've seen anyway, addendums to this new account form that you've signed that are pretty lengthy that give you your rights. Well, what's happened in the industry is that they've become more and more abbreviated and condensed, so that now it's basically one or two sentences inside your brokerage account that say, in the bottom line, all disputes are going to be settled through an arbitration process, and that arbitration, should you go through it, is dominated by Wall Street veterans that take care of the brokerage side first and you as the individual investor second. And he documents a story in here with a major firm, Merrill Lynch, that a broker had invested all of his money. He had some stock options and they were worth millions of dollars. And when the broker got done with this account, basically 2 stocks, his $1 million became hundreds of thousands, then it became tens of thousands, then it became hundreds, and then it became zero. And that the broker made more money on the investments than he made, and he lost his $1 million or $2 million. I guess it's a true case. I haven't looked into it, but and it was settled through the arbitration process, and the arbitration process had a 3-person panel, and 1 person has to be from the brokerage industry and 2 individuals not from the brokerage industry. And when you go through arbitration, I almost had to go through it. I've never gone through it, but when you go through it and you're named as a defendant in an arbitration process and a plaintiff, you have the list of who's on that who's available for arbitration, and you vote as to who goes on to that panel. But 1 person has to be from the brokerage industry so they have the experience. Well, Weiss says that it really relinquishes your rights to the court system, and it's not a fair system, according to Gary Weiss. He may be right. It may not be a fair system. It is the system. They're trying to make it easier to go through your issues and get them resolved faster than through the courts. But in order to have a brokerage account, it's almost slavery. In order to have a brokerage account now with any firm, not just my firm, not just Smith Barney, you have to sign this agreement. So if you want to open up an account, you have to sign it. If you don't sign it, your broker is not going to be able to open up the account for you. That's the system. How do you avoid it? You can't avoid it. How do you get through it? Well, hopefully you find someone that's honest and you don't have to face this issue, or you're wise enough to understand the issues before they develop into something that resolves itself through an arbitration process, and that you try to resolve it on your own end with your broker or the brokerage firm. So Weiss's comments are, we as Americans sign documents that we don't read. We buy investment products that we don't understand. We spend more time researching a refrigerator at Sears than we do researching an investment. And I've seen cases in my industry where people will call up, and I don't know these people, and I won't deal with anyone I don't know, but they'll call up because of the radio exposure or whatever, and they say, hey, Sandy, I want to buy this stock. We had someone call up just yesterday. I don't know if you remember or you know, one of the initial public offerings, an IPO that was hot, and a hot issue was something that's very active and has a lot of publicity, just came out yesterday, and it's J. Crew, which is a clothing company, very similar to the Gap. That's a hot issue because it had more people wanting to buy it than there were shares available to buy. Well, someone called up yesterday, just yesterday in my office, and wanted to buy that stock as it was coming out on the market. Well, it came out at about a 17% premium above what it initially started with, so it was a hot issue. Came out at 17, and I think it ended the day at 25 yesterday. It's a big gain in one day. They wanted to buy it throughout the day. We didn't know the person. He didn't have an account with us. And he said, listen, I'll give you the information on the phone. I'll come over and give you a check. Buy it for me right now. Well, we didn't do that because we don't know that person. We have an obligation. The broker should have an obligation to know the client, whether they're suitable for that investment or whatever. Weiss's comments are that the investors don't understand the products that they're buying from their brokers, and they don't know the background of their broker. He's probably right in that. You go into the NASD, the National Association of Security Dealers website, you can find out my history. You can find out everything you want to know about my background, where I grew up, my education, whether there have been any complaints issued against me, or whether there have been any lawsuits against me, or any issues against me. And I think I would encourage you, if you're dealing with a financial advisor, or a new one, to find that information out before you've established a relationship with him or her. It doesn't take long, and with the advent of the internet, one of his comments that Weiss says is, there's a lot of negative stuff about Wall Street. He's so against Wall Street, it kind of, he says it's akin to gambling in a crooked casino, more than investing in an honest marketplace. So he's so of the belief that you are at a disadvantage and that all the odds are stacked against you. And he says one way to correct this is to use the internet and find out about the investment, find out about your broker, find out, what are your rights. And, he's right in that regard, but the gist of the book, and I read it because, not only because I'm speaking today, but, you really want to know what people are saying about if they're calling it dishonesty that imperil your investments. Well, that's a shot right at me, right at me, right across the bow at me and my industry. And he's right in some regard. He uses very colorful characterizations of Arthur Levitt, Richard Grasso, and Elliot Spitzer, and he rips them all apart. He's trying to sell a book. And if you look at the cover, it looks like, it's got a man and a woman, and they're naked except they've got the Wall Street Journal wrapped around them. What's his objective here?
Sell the Wall Street Journal.
To sell the book. He wants to sell the book, and so you have to take that with a little bit of feeling that this is his objective. Is it all true? It's not all true what he's saying in the book, but he certainly critiques the elite part of Wall Street, and I think that's good. He's critiquing the SEC and law firms and the news media, and he's saying there's a lot of things that imperil you as the investor. You're at a disadvantage. It's like when you go to buy, I don't know if there's any car salesmen in here, or car dealers, but when you go to buy a car, are you at an advantage or a disadvantage when you're dealing with the car people? Oh man, you are in such a disadvantage because they sell 10 a day and you're buying one every 4 or 5 years, and they know what it takes to get the deal done, and you are at a disadvantage. He's saying that you are Weiss is saying in the book, you're at a big disadvantage where to go to buy a stock, and when you go to set up a brokerage account, and he says that there's really no rational explanation for how the stock market functions. And he says it's ruled by emotion, it's ruled by greed, and it's not logical, and it's not rational. I'm here to say that it is rational. It is an open society. It's an open marketplace. There are buyers and the sellers, but it's like everything else. Let the buyer beware. You've got to be, diligent before you give away your hard-earned money. As I said before, you do more research buying a refrigerator than you do buying a stock or buying a mutual fund. And there are a lot of tools that are available to you that can protect you, but you've got to be wary of what goes on Wall Street, and it does encourage corruption. We've seen it in the past. We've seen the Kozlowskis and the Kenneth Lays and the Michael Skillings being thrown into jail for a long period of time. Kozlowski's estate in Nantucket is on the market now if anyone's interested. He's got to pay his legal bills. He wants $23 million for this piece of property in a house on Nantucket Island. Where did he get all this money? I think it's from some dishonest activities, as the courts have ruled with him. And so you're at a disadvantage. There's no doubt about it. I'm at a disadvantage. If I see a stock I like and I'm reading research, if I'm not careful about who bought that research, it could be tainted research, and you wouldn't even know it, but it's out there. If you deal with a financial advisor who's recommending one fund family entirely, it's up to you to ask him or her, why are you recommending this? Is it because of the performance? Is it because of the ease and of you doing the business with this one family and no one else? Are you getting paid more? In the past, and it's brought to our attention now, your attention, I knew this, but it's brought to your attention more now. Some firms in the past have paid their brokers more to sell a specific fund family. In other words, if Merrill Lynch, and I'm using it as an example, I'm not casting any aspersions on Merrill Lynch. Merrill Lynch has a family of mutual funds called their own Merrill Lynch funds, and you go to a Merrill Lynch broker and they recommend you buy the Merrill Lynch fund. In the past, the Merrill Lynch broker got paid more for selling you the Merrill Lynch fund than the American fund or the Oppenheimer fund. So, well, you just have to be careful on how are we compensated. And it's a nasty world out there, according to Weiss. I don't think it's as bad as he says it, but certainly in the past, we were compensated, or could have been compensated, not me, but firms that had specific proprietary mutual funds, they were paid more to recommend that product or send on a trip. Yes, sir.
Is there any incentive to a broker selling a no-load fund?
Well, we sell no-load funds and loaded funds. If you were to have if a broker recommends a no-load fund to you, he doesn't get paid or she doesn't get paid at all. We work on a fee basis in our practice, not a commission basis, so we're going to look at the best investments, whether it's a loaded fund or a non-loaded fund, and recommend the best one, because our eyes are going to be on that fund. We'll get paid an annual fee for watching that, even if it's a no-load fund. But if it's just not a fee basis and you're recommended a no-load fund, they do not get paid. But you got to be careful. The Charles Schwabs out there that say we have the lowest costs and the lowest. There are fees involved, and maybe the execution isn't as good as it can be when you go to buy a stock. So there's little. No one works for free, in no matter what. They don't work for free. Yes, ma'am.
Whatever happened to that man who went to arbitration after losing all his money?
Okay, he went to arbitration. He lost. He lost the arbitration. He wasn't satisfied with that, and he went to court. He tried to get a court to hear the case, and it didn't happen because of the document he signed saying all actions have to be resolved by arbitration, not by court. So he spent a lot of money on legal expense, and he did lose all of his money. He didn't have a leg to stand on. The arbitration said that. Well, he said in his complaint that the broker had backdated a note in his file and had done some illegal activities to document it, and the court couldn't determine whether that was the case or not. The arbitration panel could not. So he lost his money, and he felt that it was the obligation of Merrill Lynch here to inform him that it was going down, that he should sell before he lost everything. And it didn't happen. It got away from the broker's attention, and it got away from his attention, too, in due respect. He should have forced the issue if he saw it going downhill fast. So he didn't win. No, I'll be here to have you ask any questions if you want about anything in my industry. Yes, sir.
Would you be kind enough to repeat how one would find the background of a prospective
Okay,
broker?
the easiest way to get the background is to go to NASD.com. NASD.com, that's National Association of Security Dealers. It's a website, and you put in your broker's name and the firm, and you'll come up with a history of that individual, and they will tell you on the internet, and it happens quickly, whether there's any current issues with him or her, or there have been in the past. And you'll determine quickly whether that person has a clean record. It's NASD.com. We are licensed, and they are our regulatory body, and we have to fill out so many documents per year about our activities. And
What does it stand for again?
National Association of Securities Dealers, NASD. Or you can go to the SEC, the Securities and Exchange Commission, as well, and do a check through them. Yes, sir.
Yeah. I find if you deal with these financial companies, funds, mutual funds, transfer agents and so forth, the number of them that ask repeatedly for your social security number, there's a number of them that even have it programmed into their telephone system, enter your social security number. And I, for one, will not give them that information over the phone, and if they ask for it, I usually have quite a bit to say about it. But it's still being done, and on top of it, not only that, but on every internal document they use, they print it out. I'm surprised that people not more cases of identity theft
They should be.
than they really are.
Yeah,
When these
the use of
financial companies
the use of the
have
social
that
security number
information
is,
in every single paper they have and everything else.
yeah, it's
What
a,
can people
well,
do to
there's-
protect themselves or get this industry to change?
because of the Patriots Act, whenever someone comes into our firm, or any firm now, and opens up an account, or even changes a registration, we have to physically see their driver's license and social security number. I think one way is just to say no if you can, and plug in a password. I think a lot of firms, if you take it another level, say to them, you know,
Right.
when you set up the account, give me a password. I'll give you the social security number once, but don't ask for it when I call in, and don't put it on any documents. Just put a password in. When I open up my computer every morning at my desk, it asks for my name, and then there's a password that I put in. We changed our passwords every 30 days, and I think that's a wise thing to have, as just a password as opposed to giving them a number over the phone. I would not give out my social security number over the phone to anybody. And, you know, if they want to do business with me, they'll have to do it another way without asking for that. I've seen too much identity theft in my time already. It's not going away.
One thing I'd like to add to that is that this year, 2006, Mellon Bank is saying they weren't going to do that. They're asking for your investor ID number. They sent out papers on that. They sent some letters to the Attorney General's office over that.
Mm-hmm.
But
They're asking for your
to my knowledge,
social
all the
security
other people are doing it.
Yeah. Well, unfortunately, in the past, the sole source of identification has been the SS number, and gradually we're seeing changes. I don't think we're going to see 100% change overnight, but even in college, when I was in graduate school, my grades were posted on the wall by social security number, and nowadays they're not done that way. So there's changes that are taking place. We need more of them, though. I agree. Yes, ma'am.
Yes. What would you say are the best sources to find out about a particular stock and its viability, etc.? I mean, I can think of a few magazines, but
I wouldn't use any magazines.
okay.
I've said on the radio a few times that I take Money Magazine, I read it because a lot of my clients read it, but I use it basically to line my birdcage at home. Money Magazine is driven by its advertisers. There's no doubt about it. And they always have their top 10 funds to buy or top stocks to buy, and they always change it because they want to drive subscription rates. There's no information in Money Magazine that's not self-serving.
What about Smart Money or Kiplinger's?
Kiplinger's is okay. They're not run by advertisers, and same with Smart Money, but those magazines that are full of pages of mutual fund companies' print aren't worth reading.
How about Forbes?
Forbes has a good reputation.
Right, because they base it on performance.
That's right. Forbes is a good place to go. But Money Magazine and those that are jam-packed of advertising, stay away from them.
Thank you.
How about Value Line? It's one of the most popular things here at the library.
Yeah, Value Line is a good source. We use it in our office. And their performance numbers have been good. They have their own mutual funds.
Yeah,
And,
we have them both here at the library.
So Value Line is a good source, as well as Morningstar. So we use those. Anything that's not driven by advertising revenue is important.
How about Investors Business Daily? Composite rating.
Yeah, the Investor Business Daily is a good competitor to the Wall Street Journal, and I read that. And I like that very much. I'd stay away from the New York Times.
How about the Daily Racing Form?
The Daily Racing Form. We've got pink sheets in our office.
What about Business Week?
Business Week, I'd stay away from. Yeah, Gary Weiss was an author, a reporter for Business Week for 18 years, and I think they have their agenda. I think it's very liberal and not entirely independent, in my opinion. I'd stay away from Business Week. Stay away from all those major magazines that have huge advertising budgets.
How about Fortune?
Fortune's okay. Forbes is better than Fortune, in my opinion. But it's a lot of reading. I mean, they're not easy to read, and it takes some time. I think you just got to hook up with someone that you can trust and hopefully, do well for you and know that you've got to go through arbitration if you're unhappy. Yes, sir.
Has the industry or the problem that they had with the mutual funds a few years ago, has that been cleaned up for the most part?
I can speak directly to that because I was involved. Yes.
And are there other problems, on the horizon, or?
I don't see any problems on the horizon. I think it's probably the regulatory bodies in this regard with mutual funds and their late day trading and their next day trading and their excessive trading in their buying shelf space. They were due. There's no doubt about it, and they've been taken to task on that, and they've cleaned up their acts immensely. And I can speak on one mutual fund company that I have a lot of money under management with, and that's Putnam. Putnam was the poster boy child for this issue, and whenever you'd see something on the NBC News or CBS, and they talk about the mutual fund scandal, they'd always show the flag, Putnam's flag, in the background. It was like, excessive. Well, Putnam has fired their whole staff, and they've put controls in place now to prevent this from happening. So I think the industry is as clean now as it has ever been clean, and I feel good about it. I know from my own day-to-day activities, this trip that I took to Boston to visit Putnam 3 weeks ago, I think it's 4 weeks now, my firm was not going to allow me to go. I've gone for 15 years. It's called their Golden Scale. And in the past, as I said, it was a great trip. I mean, we'd go to California, we'd go to Hawaii, we'd go, and it would be a 3 or 4 day trip, and you'd spend four or 5 minutes in a meeting, and then the rest of the time, and every night, you'd go back to our room, and there'd be a gift. And the gift was Tiffany's. It was big stuff. Every night there'd be a gift, and it's sailing trips, and it was labeled an educational trip back then, and it certainly was anything but that. It was a trip based on production. It was a thank you trip. It was an inducement. Well, there are no such trips anymore. Wachovia Securities, the firm that I clear my business through, did not want to allow me to go on this trip 4 weeks ago. In fact, I'd signed up for the trip, and I got an email back from their compliance department saying, we see that Putnam has informed us of your desire to go on this trip, and it's been 15 years I've been going on these trips. We forbid you from going because we view it as a production trip as opposed to an educational trip. Well, the trip involved going to Boston at 11 o'clock on Thursday morning, going right into a meeting that lasted until 6 p.m., having dinner that night, which I didn't go for $195. The next morning, having meetings till 2 o'clock and going home. That's all it was. And yet, Wachovia Securities and many other firms still view these meetings as production-based as opposed to educational-based. And so they've gone to an extreme, which always happens. And somewhere they'll come together. Maybe we'll have a fun trip. Yes, ma'am.
What do you think about the Stock Channel
CEOs come on promoting their stocks, and then they sell their stocks
Yeah.
right then and there.
That's the worst thing that you could do, is stay glued to CNBC, and a lot of people do. You know, what I can't stand about is they come out with breaking news and say, okay, we got breaking news. Well, breaking news is not breaking news. It's something to keep you glued in 24/7. And I think you should try to understand what it is, take it for what it is, and shut it off. It's not worth it. It's not worth it at all. It's self-serving, 100%.
Has any investor ever won an arbitration case?
Yes. Yeah, in fact, it's a good question, and the percentages are about 40% do win, 60% lose. But it's a 40-60, so it's not 10% versus 90. It's 40-60. It's a long process. It's a process that no one really wants to go through on either side of the fence. When I left my previous firm, which was McDonald Investments, I had worked for the last 4.5 years, division of KeyBank, I left in December 16th of 2005. And in our world, you'll find this interesting, I hope. In our world, you can't give notice that you're planning on leaving, because the firm you work for will lock you out. They'll lock you out of your office. They'll take your files and forbid you from being with your clients. They think it's their client. So for the past 12 months, the group of people that work with me, I don't say they work for me, they work with me, my group, Sanford Family Group, were very unhappy with where we were, and we had planned to leave. And we had looked at many different places. We decided to go to Wachovia for many reasons, which I won't go into right now. So on Thursday night, December 16th at 11 o'clock at night, we went into our offices and took our files, took our furniture, which belonged to us, and left the building, and went in the following morning at 8 o'clock and resigned. One sentence, I hereby resign. And we walked across the street to the building next door and opened up. That's what happens in our world. Well, KeyBank / McDonald Investments felt that we had broken our contract, we had done something illegal, and they sued me. They filed a temporary restraining order against me, trying to prevent me from doing business. It got thrown out within a day, but this is what happens in our world, and it's almost like being a slave to them, and that they feel that we're indentured to them for life, and that they own the clients, where the clients can go wherever, you guys can go wherever you want. And so it became a fight. And that following day and for the following 3 or 4 weeks, we contacted our clients as best we could to tell them where we were, sent out letters and tried to have them stay with us, and they did the same thing, and it was a fight. And that's the seedy part of our world. And he talks about the seedy parts of the business, and he says, that you're at a disadvantage. There's a lot of greed, a lot of dishonesty. Well, he's right. There is. And we try to live within the rules and regulations and do the best thing for our clients, and that's what's kept us on firm footing. But that's the greed part of the world.
How many
Stay with you. What percentage?
Right now, well, it's been 6 months now. We have 98% of our clients with us, and it was just nasty. It kept me up at night. No one wants to get served with a summons. We got served saying that you're hereby ceased and desist from doing business, and then it was all about money. It's all about money. They wanted damages. They wanted money. It's all it was about was money. So I had to write them a check.
Approximately what does a financial advisor charge for investment? Like he manages your money for you?
There's a range.
Could you give me
Sure.
a ballpark?
Sure. Depending on the dollar amount, but there's a range. It goes anywhere from 1% to 1.5% per year.
And the more money you have, the lower the percentage.
Yes, and the type of investments. If it's all bonds and we manage it under a fee basis, it's going to be less in that regard than mutual funds or stocks.
So between 1 to 1.5%?
Yeah, and the reason we do that is, as opposed to commission, is that if we're going to make a recommendation that you sell XYZ and buy ABC, it's for the right reasons, not to generate a commission, because there are no commissions. It's because our compensation is based on the value of the account. We don't want it to go down, because then we'll get paid less. We want it to go up.
And you provide advice for IRAs as well?
Oh, sure. Yep. Yeah, retirement planning.
Okay.
Yep. Yes, ma'am?
Yeah, I have a question. What did you think about Martha Stewart?
I think she knew what she was doing.
I thought so too. Because she had worked in Wall Street. She wasn't any neophyte.
No, she has a background in this business for many years before she started doing what she was doing. She was employed in Wall Street, and I think she knew what she was doing, and I think she tried to hide it. And yep.
Even for that small amount of money?
Yeah, how stupid was it?
Yeah.
The stock price went down by $20 million in her portfolio, and she tried to save $100,000 or something. Yeah.
What's your opinion about gold as an investment?
We recommend in our portfolios that we manage 3 to 5% in commodities as a hedge, but nothing more than that. Gold is off 20 some odd percent from its high of a few months ago. It's shot way up on inflation, and then it's come back down.
What do you think the future holds for it?
About where it is now.
It's not going to go much higher?
No.
Thank you.
Thank you for your time.
Thank you.
Thank you.
Appreciate it.